Whether you are a CPA or studying to become one, everyone has been confused with a cash flow statement at some point or another. So I wanted to simplify the cash flow statement for you and also go through some practical examples of the cash flow statement. So the idea with the cash flow statement is we're trying to show our inflows and outflows of cash for the year. Since we're using the accrual method of accounting with US GAAP, we want to show everything on a cash basis as well. So we have the operating activity section, the investing activity section, and the financing activities section. So the operating activities section is for the main operations of the company. And the indirect method is the most common method to use for this, to where we start out with net income, and then we're going to reverse out items that are in net income that are not actually cash transactions, such as depreciation expense. So depreciation expense is decreasing net income, but we didn't actually pay out cash for that depreciation. So then we would add it back to the net income. So we're going to go through a full example of adding back and subtracting out items. And then we have the investing activities section. This is when we are spending cash for an investment. So when we're initially crediting cash for an investment. So you can think of any of our long-term assets are going to be investing activities. The most common example is when you purchase and sell fixed assets. So the idea is that anytime your initial entry is in one section, all of the subsequent entries are going to be in the same section. So when you purchase the fixed asset, that goes in investing activities. So then when you sell the fixed asset, that goes into investing activities as well. And then the financing activities section is for when you are raising cash. So you're debiting cash and you're crediting either a loan that you took out or equity that you issued. So then with equity that you issued, the initial transaction goes into financing activities. So then when you also pay out the dividends, it's going to also go into financing activities. So we're going to take a look at two questions that have us calculate the indirect method starting at net income and then getting to the actual cash flows for operating activities. And then we're going to look at an example of a fixed asset transaction and show why we have to add or subtract the gain or the loss from the operating activity section, and then show the amounts that go into the investing activities section. So let's jump in.
So let's take a look at this first cash flow question. What is the net cash provided by operating activities for the year ended December 31st, 2022? So we use the indirect method, and we start out with $75,000 of net income. So this is our starting point. It's what we're going to make all of our adjustments to. So the first item is depreciation expense. So depreciation expense decreases our net income, but if we think about the credit side of the entry, it's just accumulated depreciation. There's no cash impact. Therefore, we need to add back the depreciation expense. So it's a $20,000 add back. We can also see in our cheat sheet that it's an add back to cash. Next, we have an increase in accounts receivable of $10,000. So the best way to memorize this is that for the operating assets, they work in an inverse way. So if you have an increase in these accounts, that means you're going to have a decrease on the cash flow statement. So we're going to subtract out $10,000. The reason for this is because your entry would be a debit to AR of $10,000 and a credit to revenue of $10,000. So the revenue would be increasing your net income by $10,000, but it's not actually affecting cash. So we have to subtract it out. Then we have a decrease in inventory. So if it's a decrease in this operating asset, that means it's an increase to the cash flow. So we add $15,000. And then we have an increase in accounts payable. So this is an operating liability, which works in a correlated manner. So if these accounts increase, that means we increase the cash flow statement. And if they decrease, then we decrease the cash flow statement. That's because in this case, if you have a credit to accounts payable, you're going to have a debit to an expense. So cash isn't affecting that transaction, but the expense is decreasing net income. So that's why we're going to add $12,000 to our cash flow statement. Then we have a gain on sale of equipment. We'll see how this works later on, but a gain is always going to be subtracted out of the operating activity section. That's because we record the entire proceeds of the sale of equipment in the investing activity section. Next, we have payment for the purchase of a long-term investment. This does not go in operating activities. This would be an investing activity because we're paying for a long-term investment or crediting cash for a long-term asset. And then we have dividends paid of $25,000. This would be a cash flow item in the financing activities section because we initially raise money through stock in the financing activity section. So when we pay dividends, it's a cash outflow from the financing activity section. So now that we've gone through each item, we're just going to add them all up. So we had the initial net income of $75,000 plus the depreciation expense that we added back. The AR increased by $10,000, so we decreased cash flows by $10,000. The inventory decreased, so we increased cash by $15,000. AP increased by $12,000, and that's a correlated change, so we add $12,000. And then we subtract out the gain of $5,000. So the net cash provided by operating activities is $107,000. Now let's take a look at this similar question to continue practicing this concept. So we're still looking for the net cash provided by operating activities. So the $95,000 of net income is the starting point. The first item is amortization of a bond discount of $3,000. This means that we recorded an expense of $3,000, but it was actually a non-cash transaction. So amortization of bond discounts or premiums are non-cash transactions. So because of that, we need to then add back this item because it's decreasing the net income, but it is non-cash. So we add it back. Next, we have a loss on sale of investment. So this is like when we have a loss on the sale of a fixed asset. So we're going to have a $7,000 loss that shows up in net income, but the entire amount of proceeds are going to show up in the investing activity section. So we're going to have to actually add back this $7,000. So when we have a loss, then we have to add it back. Then we have an increase in prepaid expenses of $5,000. So since the operating assets are increasing, that means that it's going to be a decrease to cash. Then we have a decrease in accrued liabilities of $8,000. These follow a correlated method. So that means that cash is going to decrease by $8,000. And then the issuance of common stock, that's going to be a cash increase to the financing activity section. And then repayment of long-term debt is going to be a cash outflow for the financing activities section. Because when you initially raised that debt, it was also in financing activities. So we have the $3,000 add back for the amortization. We have the add back of the $7,000 loss. We have the subtraction of the increase in prepaid expenses, and then the subtraction from the decrease in accrued liabilities. So $95,000 plus $3,000 plus $7,000 minus $5,000 minus $8,000. We have net cash provided of $92,000. In this last example, I wanted to show you a typical fixed asset transaction and explain why it impacts the investing activities section and the operating activities section. So on September 15th, year 3, the company sold a piece of machinery for $45,000 cash. The machinery is purchased in year 1 for $60,000 and had accumulated depreciation of $25,000. So the net book value of this fixed asset is going to be the $60,000 minus the $25,000. So it's essentially worth $35,000 and we're getting $45,000 of cash. So we can see that we're going to have a gain of $10,000. But let's talk about this a little bit more. So when we initially purchased this machinery, we credited cash for $60,000 and debited the machinery. So back when we purchased it, we recorded a $60,000 outflow in investing activities. This also means that when we sell it, the inflow of cash is going to be recorded in the investing activities section. So let's look at the journal entry for the sale of this machinery. So we're receiving $45,000 of cash, and when you sell the fixed asset, you need to get it off of your books. So we initially debited $60,000 for the machinery, so now we credit it. And then we had a credit balance of accumulated depreciation of $25,000. So now we need to debit out the accumulated depreciation. This leaves us with a plug number of $10,000. So how this works is this $10,000 is an increase to net income. And then we also have the cash proceeds of $45,000 that are an inflow to the investing activities section. So if we did not get rid of the gain from the operating activity section, it would look as if we had $55,000 of cash flow activity, the $45,000 cash here, and then the $10,000 gain, which is increasing net income. So we're trying to avoid this double counting. So we never need to actually count the gain or loss in the cash flow statement because the entire amount of proceeds are going to be recorded in the investing activities section. So this is why under the operating activity section, we're going to then subtract out the gain from net income. That way we're not allowing the gain to impact the operating activity section, and we let the full $45,000 be the cash inflow from the investing activities section.
So I hope you understand cash flow statements just a little bit better after watching this video. Make sure you download my free one-page cheat sheet on what increases and what decreases the cash accounts. Thanks.